please read and pay attention to the disclaimer on this slide. Niels Bohr, the famous physicist who is considered to be one of the founders of quantum theory, once said that prediction is very difficult, especially when it's about the future. Nothing truer has ever been said about the stock market. Without valuation analysis, it's very hard to know if one stock is more expensive than another. Microsoft and Palantir are leading software companies in their sectors. Their stock prices are shown on the slide. Which stock do you think is more expensive? Microsoft's stock price is much higher than Palantir's. As a result, many people would say Microsoft is the more expensive stock. However, remember the saying, you can't judge a book by its cover. The same goes for stocks. Looks can be deceiving. Let me explain. As we discussed in Lesson 2, Part 1, when you buy shares in a company, you're buying an ownership stake in that company. That ownership entitles you to a share of the company's earnings proportional to your ownership percentage. For example, if you own 10% of the total number of shares in a company, you're entitled to 10% of the company's earnings. So, without knowing how much earnings per share Microsoft and Palantir earn, it's very hard to determine which one is more expensive. Think of all of this in terms of two magic boxes. Each box, if purchased, will pay the owner a certain sum of money every year for the rest of the owner's life. The box on the left costs $1,000 and the box on the right costs $200. If the cost of the box is not an issue, what would you want to know before picking which one to buy? The obvious question is, how much does each box pay the owner per year? As I said, the box on the left costs $1,000. It pays the owner $500 a year for life. The box on the right costs $200 and it pays the owner $20 a year, also for life. If it were you, would you rather buy the magic box on the left for $1,000 or the one on the right for $200? The payback for the box on the left is 2 years. You get your cost back after 2 years. The calculation is the cost of the box, $1,000, divided by the yearly payout, which is $500 a year. The payback for the box on the right is 10 years, which is calculated by dividing the cost, $200, by the yearly payout of $20. So the box that costs more is the better deal, because you get back what you paid for it faster. Now let's go back to the Microsoft and Palantir comparison. Look at the information presented on the slide. Microsoft's stock price is $376.04 and its earnings per share is $9.68. 376.04 divided by 9.68 is 39. So investors are paying 39 times $1 of earnings from the company. That's a price-earnings ratio of 39. On the other hand, Palantir's stock price is $17.17 and its earnings per share is 15 cents. 17.17 divided by 0.15 is 114. So investors are paying 114 times $1 of earnings from the company. That's a price-earnings ratio 114. On a price-earnings basis, Palantir is trading at a more expensive valuation than Microsoft. So, just like with the two magic boxes, where the box that cost more was actually less expensive, Microsoft's stock is cheaper than Palantir's despite having a much higher stock price. It's hard to tell without looking at the price-earnings ratios for the two companies, isn't it? As we saw with Microsoft and Palantir, different companies trade at different price-earnings ratios. Presented on this slide are three very different retail companies. Amazon is the undisputed king of online retail. Walmart is the largest discount retailer in the world. And Macy's is an old-school department store chain. Like I said, all three are retail companies. Yet, the three have very different price-earnings ratios. Why would the ratios be so different? What would cause investors to pay so much more for one company's earnings over another? To answer that question, let's go back to the magic boxes, but let's change one piece of information. In this example, the box on the right, which costs $200, pays the owner $20 a year, but now the amount it pays the owner doubles every year after the first year. For example, At the end of the first year, it pays $20. The next year, it pays $40 and then $80 the next, and so on and so on. Is the box on the left, which costs $1,000, still the better deal? No, it's not. After 5 years, the box on the right will start paying more every year than the box on the left, despite costing 80% less. Again, in your mind, switch the magic boxes for stocks. Can you see why investors might choose to buy stocks with higher price-earnings ratios than other stocks? The answer is superior earnings growth. The biggest shortcoming of the PE ratio is that it fails to factor in future earnings growth. It provides only a snapshot of a company's valuation relative to current earnings. Often, a company that looks more expensive based on its current PE ratio is, in fact, a better bargain when considering its future earnings potential. Think of it this way. You're shopping for an apple tree. There are 2 baby trees for sale. One of the trees will grow substantially over time and produce many more apples than the other tree, which never grows much. Knowing this, you wouldn't pay the same for the trees just because they're the same size today. Stocks are no different. As is the case with the 2 apple trees, with stocks, investors care more about what companies will earn in the future than today. This is why the stock market is described as forward-looking. Look at the image on the slide. We have a car driving on a bridge during a beautiful day. So far, it's been a great trip. However, the bridge ahead has collapsed and the car is speeding towards doom. The future looks grim. Now look at this different image. There's a car driving through horrible weather conditions, but just ahead are clear skies. The future is looking brighter. If the cars were stocks, investors would typically punish the one on the left and reward the one on the right. Inexperienced investors often suffer great confusion as to why their stocks are performing poorly, while the company fundamentals remain strong. The forward-looking nature of the market is often the reason for that disconnect. I'll give you an example. Bed Bath & Beyond used to be an American big box retail chain specializing in housewares and furniture. It was once a household name with over 1,500 stores across the United States and Canada. The company's stock hit an all-time high of around $81 per share in 2014. That turned out to be the top in price. It's noteworthy that although Bed Bath & Beyond's stock reached its high in 2014, the company's revenue actually continued to increase until 2017, indicating that the stock price peaked significantly earlier than the company's business performance might have suggested. Surprisingly, from the stock's high in 2014 to 2017, its price fell by 75% despite the continued revenue growth. Unfortunately, the situation deteriorated further, and by 2023, 6 years after revenues peaked, the company declared bankruptcy. After the 2017 peak in revenue, the company experienced a steady decline in sales because of shifting consumer preferences for online shopping from the likes of Amazon and competition from other big box retailers like Target and Walmart. Why did Bed Bath & Beyond's stock price peak years before their business did? This is an incredibly important question. The answer is because of what I've been describing as the stock market's forward-looking nature. In this case, the market correctly predicted that competition from the likes of Amazon was going to crush the company years before it actually happened. As a result, the stock price suffered years before the business started to decline. You should know that the stock market has a pretty good record at predicting long-term peak performance in companies.